Hello, I'm James, and in this video we're going to talk about the PB ratio, which is my personal favorite ratio for identifying undervalued stocks. The PB ratio, in short, tells us at the current price of the share, how much are we actually buying? How much does that company have in the bank and in assets and stuff that it owns? So when we buy a share at this price, are we buying it at a discount or are we buying it at a premium? The PB ratio is the price per share divided by the tangible book value per share, which is quite a mouthful, but it's not that complicated. I'll explain. The tangible book value is basically just adding up all of the tangible stuff that the business owns, including cash, inventory, and say buildings and machinery, and taking the dollar value of all of those things if we were to sell them off to turn into cash, and then subtracting away the stuff that the business owes. Now that can be in terms of, the money that it owes its staff, and paying back the loans that the business might have. The tangible book value is what's left over after you do that. So once you've sold off all the assets and you've just got cash, and then you've paid back all the money that the business owes, what's left over is the tangible book value. So let's take an example. Let's say we've got a business that has $2 million of cash in the bank. It also owns $5 million worth of buildings and machinery. That means the total asset position of the business is $7 million. Now let's just say that the business owes $2 million worth of liabilities. It owes $1 million to its staff in the form of wages, and it owes $1 million worth of money in loans and debt. So maybe to a bank, it took out a loan to buy some machinery. In this case, that means the tangible book value is $7 million worth of assets minus $2 million worth of liability. That gives us $5 million left over of value. But that's not quite the whole picture. So that's the total amount, but we also have to remember that the company has a lot of shares outstanding, which means the ownership of all of that money is divided up into the total number of shares that the business has outstanding. Now for this example, let's just say there are 1 million shares. So that means the tangible book value per share is $5 million divided by 1 million shares, which gives us $5 per share. Okay, great. So now we know the tangible book value per share. Let's go back to the PB ratio. Now, if we place ourselves in March 2020 again, when there was just panic sell-off in the stock market, and let's just say this company in our example was one of those companies that was being sold off in March. Now, for example's sake, let's assume that investors were selling this stock at $1 per share. If we plug that into our price to book formula, we can see that the price per share is $1 and the tangible book value is $5 per share, which means our price to tangible book is 1/5 or 0.2. Now you look at a number like 0.2 and it's like, what does that mean? Well, if this value is less than 1, that effectively means we're paying less than $1 for $1. So in this case, because the price to book value is 0.2, we're paying $1 per share for $5 worth of value. I don't know about you, but I like those numbers. One example of a stock that I bought in March One example of a stock that I bought in March that fits this criteria is ATS. So I bought ATS at a price to tangible book value of 0.03, which effectively means that at the value of the assets the company owned last year, I bought $33 worth of value for every $1 that I invested. Now that doesn't mean that I've gone 33x on that investment. So far that position has actually more than 3 times multipled since March. However, that's sort of irrelevant, but it just demonstrates the value in looking at indicators like this that don't just tell us what the price is currently, but instead focus on what's the underlying value of what we're actually buying when we buy a share. Now, as another example, if we see a price to book ratio of 2, that effectively means we're paying $2 in price for $1 worth of net tangible asset value. Now, this isn't necessarily a bad thing in optimistic, normal market conditions, but in a situation like what we saw in March, we can see price to book values drop well below 1, which can be a really good indication for us that there is great buying opportunities for certain stocks that we decide that we like. Now, generally, we would expect, a good price to book value would be somewhere around 1.5 or 2. Like, that would be pretty good in normal market conditions. However, if we see another big downturn, we can use the price to book value, the ratio, as a way to identify, some really, really good buying opportunities. Now, I would say this isn't the only tool that you use. You would use a number of indicators to get an idea of the safety of the investment, but this is my personal favorite. Now, there's one important thing to note with the price to book value. This ratio, and particularly that tangible book value on the bottom, that is dependent on what we think the value of the assets actually are. So in the company's last financial statement, when they recorded on their balance sheet, the value of how much money they had. So let's say, $2 million in cash in the bank, $5 million worth of buildings and machinery, as per our example earlier. That assumes that if we were to liquidate the company right now, meaning if we were to sell off those assets, that we would be able to recover the price of those assets that was recorded on the balance sheet. So for example, if there's $5 million worth of real estate, well, in the current economic environment, would you really, realistically be able to sell that real estate for $5 million? Or would it be more likely to sell for $4.5 million or maybe $4 million? So this is where I like to use the bankruptcy test that I talked about in my last video, the current ratio, which gives us an idea of how likely a bankruptcy event is to occur in the next 12, 18, 24 months. So if we see, a really, really good looking price to book value of less than 1, let's say 0.5, meaning we're paying $1 for $2 worth of value, and we don't really want the company to go bankrupt, then we can use that bankruptcy test video here in order to identify how likely that is to happen. Okay, so to wrap this up, the PB ratio is a great way for us to see if we're buying $5 worth of value for $1 or if we're paying $5 for $1 worth of value. If you enjoyed this video, please give it a like and let me know in the comments what kind of content you'd like to see in the future. I look forward to speaking with you soon.